Everyone wants to be a millionaire, but most of us lose our hard-earned money because we gamble on stocks, not knowing the fundamental and historic performance. Investing wisely is key, and the best solution is exchange-traded funds offering diversification with proven records. In this video, I'll be showing you and John 6 Millionaire portfolio ETFs, each with the potential to reach $1 million valuation. But the question is, how much do you need to reach $1 million valuation in 10 years, 20 years, and 30 years? Stick around. There are ETFs that need less than $10,000 to reach $1 million valuation. And in the end, I'll show you which ETF is the best and needs the least amount of investment if you have 10 years, 20 years, or 30 years. Many of you have been asking in the comments to show us how we can reach the $1 million valuation in less than 10 or 20 years. So here it is. This video's for you guys. Starting at number 6, we have Schwab US Dividend Equity ETF. Known by the ticker symbol SCHD, this ETF is a popular choice for investors seeking broad exposure to the large cap value segment of the U.S. equity market. With over $54 billion in assets under management, it stands as one of the largest ETFs in this category. This ETF has a current dividend yield of 3.46%, backed by a dividend growth rate of 10.87%. Additionally, it also has an average share price growth of 7.56%. What this shows is that this dividend ETF is more focused on growing dividends. And since we're using the DRIP strategy, which in simple terms is reinvesting dividends for the snowball and compounding effect, this ETF will require less investment over the long term, but slightly more if you want to cash out early. Speaking of which, here's how much you need to invest to reach $1 million valuation in 10, 20, and 30 years from now. To reach $1 million valuation in 10 years using SCHD, John needs to invest around $335,000 today in this stock. But to reach the same valuation in 20 years, he needs to invest around $98,000, and this amount significantly lowers when the timeline is increased to 30 years, as John needs to invest only $24,000 to reach a $1 million valuation. This is because as time goes on, the investment with dividend reinvestment pays even higher dividends, which, like a snowball, keeps getting bigger and bigger as you give it more time to grow. As for the strategy, SCHD follows a passive management strategy, seeking to match the performance of the Dow Jones U.S. Dividend 100 Index. This index includes high dividend-yielding stocks issued by U.S. companies with a consistent record of dividend payments, selected for their fundamental strength relative to peers. In terms of performance, SCHD has delivered a return of approximately 7.58% over the past year. That's higher than its average, but like we said, this fund is more about growing dividends over time. Top holdings include Chevron, Texas Instruments, PepsiCo, Lockheed Martin, and Coca-Cola. This diversification helps spread risk across different sectors and companies. And if you're wondering where I get all that data from, let me tell you about our channel's official partner, Seeking Alpha. It's been my go-to tool for winning in investments. It's easy and simple, and I love how I can access under-the-radar investing ideas, earnings call transcripts, and breaking news. Plus, the exclusive data-based stock ratings have been a game-changer. Stocks rated strong buy and their alpha picks have beaten the S&P 500 by over 80%. So definitely check them out in the description. They've promised to give a 20% discount on premium membership with a 7-day free trial and a 10% discount on alpha picks to our community if you join using the link from the video description. Okay, now back to our list. At number 5, we have Vanguard Growth ETF. Known by the ticker symbol VUG, this ETF is a passively managed exchange that aims to provide broad exposure to the large-cap growth segment of the U.S. equity market, with assets over $226 billion. This ETF has a current dividend yield of 0.57% and a dividend growth rate of 4.74%. But this ETF is more about increasing wealth by capital appreciation, which can be seen from its average share price growth of 13.32%. Based on these metrics, to reach $1 million valuation in 10 years using VUG, John needs to invest around $280,000 today in this stock. But to reach the same valuation in 20 years, he needs to invest around $80,000. And this amount significantly lowers when the timeline is increased to 30 years, as John needs to invest only $23,000 to reach a $1 million valuation. In the end, I'll show you which ETF is the best and needs the least amount of investment if you have 10 years, 20 years, or 30 years. Back to VUG. It follows a passive investment strategy seeking to match the performance of the CRSP US Large Cap Growth Index. This index represents growth companies within the CRSP US Large Cap Index, targeting firms with faster growth rates and higher valuations. In terms of performance, VUG has shown impressive returns with a gain of approximately 38.23% in the last year. Its beta of 1.1 and standard deviation of 23.32% indicate a medium risk profile with potential for volatility. However, its diversified portfolio of about 236 holdings helps mitigate company-specific risk. Top holdings include tech giants like Apple, Microsoft, Nvidia, and Amazon, collectively accounting for about 38% of total assets under management. VUG holds a Seeking Alpha rating of buy, indicating strong potential for investors. Next on the list is Schwab US Large Cap Growth ETF. Known by the ticker symbol SCHG, this ETF aims to provide broad exposure to the large cap growth segment of the U.S. equity market with assets totaling over $25 billion. This ETF has a current dividend yield of 0.45% and a dividend growth rate of 4.07%. Contrary to its SCHD brother, this ETF is about capital appreciation with an average share price growth of 14.36%. So to reach $1 million valuation in 10 years using SCHG, John needs to invest around $255,000 today in this stock. To reach the same valuation in 20 years, he needs to invest around $67,000, and this amount significantly lowers when the timeline is increased to 30 years, as John needs to invest only $17,500 to reach a $1 million valuation. SCHG follows a passive investment strategy seeking to match the performance of the Dow Jones U.S. Large Cap Growth Total Stock Market Index. This index comprises large cap growth stocks within the Dow Jones U.S. Total Stock Market Index, targeting companies with faster growth rates and higher valuations. In terms of performance, SCHG has delivered impressive returns, with a gain of approximately 42.92% in the last year. Its beta of 1.09 and standard deviation of 23.44% indicate a medium risk profile with potential for volatility. However, its diversified portfolio of about 253 holdings helps mitigate company-specific risk. SCHG holds a Seeking Alpha ETF rating of buy. While SCHG stands out for capital appreciation and its low expense ratio of 0.04%, investors may also consider alternatives like Invesco QQQ Trust, which is our next ETF on the list. Known by the ticker symbol QQQ, this is an exchange-traded fund that has gained significant attention as a top performer in recent years. It focuses on large cap growth stocks and has become the top performing actively traded U.S. diversified ETF over the past decade with an impressive annual gain of 18.1%. This ETF has a current dividend yield of 0.58%, not huge, but it has a dividend growth rate of 9.93%, and also its average share price growth of 17.05% has been exceptional, outpacing other ETFs in its category, suggesting this ETF is both dividend and growth focused, and a perfect middle ground on our list. To reach $1 million valuation in 10 years using QQQ, John needs to invest around $200,000 today in this stock. And to reach the same valuation in 20 years, he needs to invest around $41,000. Of course, this amount significantly lowers when the timeline is increased to 30 years, as John needs to invest only $8,500 to reach a $1 million valuation. The strategy of QQQ is straightforward. It invests in the 100 largest non-financial stocks listed on the NASDAQ, which are predominantly growth-oriented companies. This concentration in large-cap growth stocks has been a key driver of its success, particularly as growth stocks have continued to outperform value stocks in recent years. Top holdings of QQQ include tech giants like Apple, Microsoft, Nvidia, and Amazon. While growth stocks have been the market's leaders in recent years, it's essential for an ETF to consider the historical performance of value stocks over very long periods. QQQ does that, and that's why it remains an attractive option for investors seeking exposure to large-cap growth stocks. At number 2, we have ProShares S&P 500 Dividend Aristocrats ETF. Known by the ticker symbol NOBL, this ETF aims to provide broad exposure to the style box large-cap value category of the market. It has a current dividend yield of 2.08%, backed by a consistent dividend growth rate of 18%, and a good share price appreciation of 8.14%, suggesting this ETF is leaning more toward dividend income. And since we're using the DRIP investment strategy, this ETF is going to benefit from your investment in the long run. Here's how it looks. To reach $1 million valuation in 10 years using NOBL, John needs to invest around $339,000 today in this stock, significantly higher than the others. To reach the same valuation in 20 years, he needs to invest around $74,000. This is good, but still higher than the others, because it's after 20 years that the snowball effect truly starts to take hold. With this ETF, when the timeline is increased to 30 years, John needs to invest only $5,500 to reach a $1 million valuation, lowest of any ETF on the list. Next up, I'll show you an ETF that has a good score in all 3 timelines, and in the end, I'll show you which ETF is the best and needs the least amount of investment if you have 10 years, 20 years, or 30 years. Back to NOBL. It uses a smart beta strategy, which focuses on selecting stocks based on specific fundamental characteristics rather than market capitalization weighting. Specifically, it seeks to track the performance of the S&P 500 Dividend Aristocrats Index, which includes companies that have increased dividend payments each year for at least 25 years. With approximately 68 holdings, the ETF effectively diversifies company-specific risk within the large-cap value segment of the market. And finally, topping our list at number 1, we have Vanguard Information Technology ETF. Known by the ticker symbol VGT, this passively managed exchange-traded fund has garnered assets totaling over $77 billion, making it one of the largest ETFs in its category. This ETF has a current dividend yield of 0.74%, backed by a massive dividend growth rate of 14.36%. To top it off, it comes with an 18.38% on average share price growth over the years. Before showing you how much you need to reach a $1 million valuation in 10, 20, and 30 years, let's get to know the ETF first. VGT seeks to match the performance of the MSCI US Investable Market Information Technology 2550 Index before fees and expenses. This index is designed to provide exposure to the broad technology sector in the U.S. equity market, transitioning in and out of securities affected by pending updates to the sector. In terms of performance, VGT has delivered impressive returns, with gains of approximately 37.28% over the past year. Its medium risk profile, with a beta of 1.15 and standard deviation of 26.12% for the trailing 3-year period, indicates potential for volatility. However, its diversified portfolio of about 367 holdings helps mitigate company-specific risk. Sector exposure reveals a significant allocation to the information technology sector, comprising about 90.7% of the portfolio. Top holdings include tech giants like Apple Incorporated, Microsoft Corporation, and NVIDIA Corporation, collectively accounting for a significant portion of total assets under management. So how much does John need to invest to reach $1 million in 10, 20, and 30 years? Here's the breakdown. To reach $1 million valuation in 10 years using VGT, John needs to invest around $176,000 today in this stock. And to reach the same valuation in 20 years, he needs to invest around $32,000. But this amount significantly lowers when the timeline is increased to 30 years, as John needs to invest only $5,700 to reach a $1 million valuation. Knowing all that, you can see that the time to reach $1 million over different timelines for each ETF looks something similar to this. Now, want to know how to turn a $10,000 investment into over $2 million? Click the video on the screen.